Hello guys, welcome to another video. Today we're going to be looking into using Python to obtain some basic information on stocks. Mainly we're going to be working with Yahoo Finance to obtain the adjusted closing price over a certain period of time. And we are going to look into how to use that information and other types of information such as average traded volume, annual rate of returns. And we're going to plot that information in order to see it graphically, and hopefully it will help us make better investment decisions. We're also going to be looking into how to calculate the 50 and 200-day moving averages, do some volatility analysis, and calculate some performance indicators such as cumulative annual growth rate, annualized volatility, Sharpe Ratio, Sortino Ratio, and also the Calmar Ratio. If you don't know what those are, don't worry. I will be leaving you links in the description below. Feel free to check them out. If you're new to this channel, my name is Silvio. Thank you very much for joining me, and let's get into it. So let's get right into it. We're going to start by pip installing Yahoo Finance, the Python library that gives us access to Yahoo's data API. In my specific case, I have already installed it, so it's telling me the requirement has already been met. So let's start by importing the libraries that we need. We will start by import yfinance as YF. And we will also import Matplotlib.pyplot as PLT. This is the library that will allow us to plot the data graphically. And I will also set the plot into line, matplotlib in line, and we will define a variable called data, and this will be equal to our Yahoo Finance .download, and we will want to download the data for Apple. And we will want the data to be from 2021 01/01 to 2021 12/31. Next, we want to take our adjusted close data, so the adjusted close column from our data frame that is just stored into this variable called data. So we will say data adjusted close will be our plot, and we will call our plot to see it. And there we go. As simple as this, to create a plot to graphically demonstrate from the 1st of January of 2021 to the very end of 2021, the 31st of December, how the price, the adjusted close for Apple moved from day one to the very last day. Next, instead of plotting data, let's say we just want a data frame and we want not for one stock, but let's say we want for 3 stocks. So what we would do is we would define an empty variable called ticker list, and this would be equal to a list. And in here, let's say we will use 3 stocks. We will use Apple, and then we will use Google, and let's also use Microsoft. Okay. And we will say that our data now will be equal to Yahoo Finance.download, and in here we will pass our ticker list, and we will say that we want it again from 2021-01-01 to the last day of December 2021, so 2021-12-31. And now we will print our data and only the head of the data for the time being. And there we go. As you can see, head of the data will only print the first 5 rows. So as you can see, we are just downloaded for Apple, Google, and Microsoft the different type of adjusted close, volume, all the different parameters that Yahoo allows you to have access to. If we would remove head from here, it would not only print the first 5 rows, as you can see here, it has 18 columns and 5 rows. It would return us the 18 columns, but the 251 rows, because it will show us data from the 1st of January, or in this case from the 4th of January, because the 1st, the 2nd, and the 3rd were holidays. And all the way to the very last day of December, the 30th, because also the 31st was a bank holiday as well. Now let's make it more interesting. Let's say we wanted to plot graphically the cumulative returns of all of these three stocks over the course of this year. With Python, we can do that quite easily, but we need a little bit of a bigger data set. So we will say that our data will be equal to Yahoo Finance dot download, and we will take our ticker list, and we will say that we want data as of, let's say 2015-0101, the 1st of January of 2015. You can even say 1-1, like this. And we only want our adjusted close column for this case, okay? Next, we will say that our data percentage change function plus 1 will be the cumulative product function, and we will plot this with a fixed size, let's say 10 by 7. Yes, 10 by 7. And we will also give a legend to our plot. Next, we will give our plot also a title. We will say the title will be returns, and we will give returns a font size of 16. Next, we will say that next we will give our plot axis some labels as well. So we can say that our plot Y label will be equal to cumulative returns, and we give this a font size of 14, and plot X label will be year, and we give this a font size of 14 as well. We can also give some grid lines to our plot. So let's say our plot.grid, which major will have a color of K. Our line style will be equal to this, and our line width will be equal to, let's say, 0.5. And to finish it up, we will show our plot. We have a little error here, which we should give it an equal before, and this should work out nicely. There we go. As you can see, this returns a nice plotted graph for Apple, Google, and Microsoft with the cumulative returns from 2015 all the way to the end of 2021, showing us the cumulative returns over this period of time for all three companies. Now let's look at another case. Let's say we want not a graph, but we want a data frame, and we want this data frame not to have a period interval of 1 day, because right now we've been giving adjusted closes for every day, but let's say we want the adjusted close for every minute over the past 5 days. We can do that quite easily as well. We can say that our data is equal to Yahoo Finance.download. We can say that our tickers is equal to, let's take Apple for this case. Let's say that our period will be 5 days, 5 days as a string, and that our interval will be equal to 1 minute. Then we can print our data. And there we go. That will give us 1,872 rows, which is exactly the amount of minute interval data we get for Apple over the course of the last 5 days. Now let's say we wanted to analyze the overall volume traded for these three companies since 2015, and we want to plot that data. We can do that as well. We will need a few more libraries for this. So we will start by importing pandas as PD for some data management, also later on for our indicators. We will import NumPy as NP. We will import Matplotlib.pyplot as PLT. Let me get rid of this. Let's also import pandas plotting, and from there we import scatter matrix, and we need to actually say from pandas plotting we import scatter matrix, and we also import yfinance as YF. Yes. Again, we would declare Matplotlib to be inline. Next, we will define a start date. So our start date will be equal to, we said 2015 0101, and our end date will be 2021 December 31st. Okay. Now our data will be equal to Yahoo Finance.download, and we will have to give it obviously a ticker list. Let's say our tickers list will be equal to this list, where we say it will be Apple, Google, and also Microsoft. Our downloads, let's separate this by a little underscore. Our Yahoo Finance download will be our tickers list, and it will be from our start date to our end date. And if we print the data, there we go. It gives us the same data. Yes, just as we did earlier before. In this case, we don't need a print statement here. What we need is to isolate our volume, and we can do that by saying data, our volume column, volume, and we will plot this data, and we will give it a fixed size of 15 by 7. We will also give a title to our plot, so we're gonna say that plot title will be trading volume, and we will also give a legend to our plot, and we will show the plot to finish. And there we go. This shows us the trading volume for Apple, Google, and Microsoft over the course of 2015 until 31st of December 2021. Now let's say we want to calculate some performance indicators. We could calculate, for example, the 50 and 200-day moving averages. To do that, let's target, instead of 3 companies, just 1 company. So we have to create a new set of data. We're going to say that our Apple data is going to be equal to Yahoo Finance.downloads for Apple. And we want it to be from the start date to the end date, which we have defined already here as 2 variables just above. Yes. And if we will print our Apple data, there we go. This gives us the Apple data nicely. Yes. So let's say we want to calculate the 50 and 200-day moving average. So we can say that our Apple and create a new column called MA50 will be equal to Apple, and for this we want to target our open price column, and we will do a rolling mean over 50 days and call the mean function. And to do for the 200 days moving average, we can do exactly the same. We just call it 200 instead, and here we will do it for 200 days, and it's the mean as well. Our Apple open price will be plotted. We can give it a fig size of 15 by 7 again. Our Apple MA50 will be also plotted, and we will give this a label, and the label will be MA50, and we will do the same for our 200-day moving average. We'll just change this to 200 instead, and here we'll also give it 200 instead. Then we'll give it a legend, and we will give our plot a title, and we will say that our title in this case will be 50 and 200-day moving average for Apple. Okay, we finish this with showing our plot. Execute this. We get a small error because here it's rolling, not rolling. And we execute this again, and obviously made the same mistake here because we copy pasted. And there we go. We get the rolling moving averages for the 50 and 200-day periods for Apple from 2015 until the end of 2021. Now let's say we want to analyze the volatility span analysis in a graph. We could do this as well. Quite simply, we will say here is volatility span analysis, and we will create a new column called returns, and this column will be equal to our Apple closing price divided by our Apple closing price at shift position dot shift 1. So the closing price divided by the next day's closing price, or rather the closing price divided by the previous day closing price, and all of this minus 1. And we will say that our Apple returns column is historically with bins at 100. And we'll give it a label of Apple. We will give it an alpha value of 0.5, so it's a histogram, and a fixed size equal to 15 by 7. We will give this a legend, and we will give it a title, and we will call it Volatility Span for Apple. We will show the plot, and there we go. This gives us a volatility span for Apple over the past few years. So from 2015 January until again December 2021. Now let's say you want to calculate some more complex performance indicators. Let's look at cumulative annual growth rate. To do that, let's start by commenting that this section will be cumulative annual growth rate, and we will define a function to calculate this. But before anything, let's get some new data for this. Let's say that our stock data will be equal to Yahoo Finance stock downloads Apple, and we will start date. We'll give it a start date of, let's say, 2018 0101, so the 1st of January 2018, and we give it until let's say 2021 the 31st of December. Okay, this will give us stock data. There we go. Next, let's define a function. We call it cumulative annual growth rate, or CAGR for short, and this will take in some data. And in here, we'll say that our data frame will be equal a copy of this data that we pass into this function, and we will give our data frame a new column, and we'll call it daily returns, and we will say that our daily return is equal to the data frame adjusted close column, and we will calculate the percentage change over this. Okay, and then we will give it a new column, and we'll call it cumulative returns, and here we don't really need this underscore, will be equal to 1 plus our data frames daily returns column, and we will calculate the cumulative product over this column. Okay, and now per year we have about 252 trading days. So we will have to find out how many trading days we will have over the length of this data frame. So we will say that our n will be equal to the length of our data frame, and we will divide this by trading days. Okay. And now to calculate our cumulative annual growth rate, this will be equal to our data frames cumulative returns, and this will be at position -1, and we will multiply, or rather we will exponentially calculate this at over 1 divided by n, and we will subtract 1 from this and return our CAGR variable. Okay, So let's see if this works. Let's print out our CAGR will be equal to, and we'll give it a string, and the string will be our CAGR function that we defined, and we'll pass it in our stock data that we just obtained. And this stock data will be multiplied by 100 because we want a percentage, and we will add a percentage sign to the end of this string. So it gives us the number plus the percentage. Let's see what this gives. And there we go. It calculates that between 2008 January and the 31st of December 2021 for Apple, our adjusted close percentage change gave us a cumulative annual growth rate over this period of about 44.27% annualized. We could also calculate annualized volatility. So let's say here we calculate annualized volatility. Our annualized volatility, for this we can define another function. We can say that this is our volatility function, and here we give it also some data. And in here we will do the same. Our data frame is equal to data.copy, and we will define a new column, and we call this column daily returns as well. And again, we will say that this is our data frame adjusted close percentage change. So we can just copy this from here above. And we can say that our trading days are again equal to 252. Our volatility will be equal to DF, our data frames daily returns column, and we calculate a standard deviation on this, and we multiply it by square root of the trading days. This will give us our volatility rate, and we will return our volatility. Wait, this has been misspelled. Return volatility. There we go. And we can print this. So let's print that our annualized volatility is equal to, and we pass it the string of our volatility function, which takes in stock data. You have to multiply it by 100 because it returns a decimal number. And at the very end, we will give it a little percentage sign. Okay, let's see what this gives. And there we go. Our annualized volatility rate for Apple from 2008 January to 2021 December is approximately 32.89%. Now we can calculate, for example, Sharpe and Sortino ratios. So let's comment here Sharpe and Sortino ratios. And we can define two functions for this. So let's define Sharpe, and this takes in data and an RF value. And we will say that our data frame will be a copy of our data. And here the Sharpe ratio will be equal to, and we will calculate the cumulative annual growth rate. So we already had that defined as a function before, and we pass it in our data frame, and from this we will subtract the RF ratio. And we will divide this by our volatility formula, and our volatility formula takes in the data frame as well. At the end of this, we return our Sharpe ratio, and that defines our Sharpe ratio formula. Let's also define a Sortino formula, and this also takes in data and also takes in an RF value. And here the data frame will be equal to data.copy, as well as the same. For this case, we will need our daily returns, which we already had done above, so we can just take that. We will need to create a new column called negative returns, and this will be equal to numpy where, and we can say our data frames daily returns column, and we will want to look for where it is less than 0. And then we pass it again our daily returns column and a 0. There we go. Now we can see that our negative volatility, we declare this as a variable, and we see that this is equal to our data frames negative returns column. And on this we calculate a standard deviation, and we do this multiplied by the square root of 252, which is the amount of trading days that there are in a year. Now that we have our negative volatility, we will calculate our Sortino ratio, and the Sortino ratio will be equal to, for this we need our cumulative annual growth rate, which we already had created as a formula before, so we can just call it here. So we call CAGR, and into it we pass our data frame, and from this we will subtract our RF value, and we will divide this by our negative volatility. There we go. This gives us our Sortino, and we will end this by returning Sortino ratio. Okay. Now we can say that print, and we say Sharpe Ratio, and we will add to this the string again of our Sharpe, and Sharpe takes in our stock data, and we'll give the RF a value of, let's say, 0.03. Okay. Next we will print out just a little separator to separate the Sharpe ratio from the Sortino ratio, and we will print Sortino ratio base, and we will pass a string of our Sortino formula, and Sortino takes in again our stock data, and we will also give it 0.03 as our RF value. Let's see what this returns, and there we go. It returns that for Apple between, again, 2008 January and December 2021, our Sharpe ratio was approximately 1.25, and our Sortino ratio was about 2.07. Very nice. And lastly, we will calculate the Calmar ratio. So for the Calmar ratio, we will need to define two functions, because we also need to calculate the maximum drawdown in order to calculate the Calmar ratio. So for that, we will define max drawdown as a function, which takes in our data. And in here, we will say that our data frame is again going to be equal to data.copy. For this, we also need the daily returns. So we will create that column, and then we will need to create a new column which is called cumulative returns, and this will again simply be equal to 1 plus our data frames daily returns column, and on top of all of this we will calculate the cumulative product. There we go. Then we will create a new column, we'll call it cumulative max, and this will be equal to our data frames cumulative returns, onto which we calculate the cumulative maximum values. And to finalize, we have to create a drawdown column, and this drawdown column will be equal to our data frames cumulative max column, onto which we subtract our data frames cumulative returns. There we go. Drawdown. There we go. And then we will also create a final column, which is drawdown percentage. And this will be simply our data frames drawdown column divided by our data frames cumulative max value. And then our max DD variable will be equal to our data frames drawdown percent, and we will find out what the maximum value is in this column, and we will simply return the max maximum value. So max DV. This gives us our maximum drawdown, yes? And now our second function, the Calmar function, will be define Calmar, and this takes in data and an RF value as well. And here we will say that our data frame will be equal to data.copy. And our Calmar ratio, here we will also have to use our cumulative annual growth rate function. So we will call that in here, and we will say that our CAGR, which takes in our data frame, from this we will subtract the RF value, and we will divide all of this by our max drawdown function, which also takes in our data frame. Okay, and we will return Calmar from this. And to finish this, we will print our Calmar ratio, and this will take in a string of our Calmar function, which takes in our stock data and a value of 0.03 as well. And when we print this out, it gives us a Calmar ratio of 1.071 for the stock of Apple for the period between 2018 in January and December 2021. And with that, we come to the end of our video. I hope you enjoyed it. If you want to learn more about these performance indicators, feel free to look for the links in the description below. The definitions of Calmar ratio, Sharpe ratio, and some other performance indicators that we have looked over in this tutorial. If you like this video, don't forget to comment, like, and subscribe. That will help us greatly with the YouTube algorithm as well. Thank you very much again for watching this video, and see you in the next one.